Hi everyone, and welcome to another episode of our life insurance video series. I'm Megan and I'm joined today by Russell Kane, CEO of Life Insurance Direct. Welcome back, Russell.
Hi Megan, looking forward to the series with regards to finding out more about some life insurance today.
Absolutely. So today we'll be covering an important topic, how to choose the right life insurance cover. I know that navigating life insurance can be overwhelming, so we're going to break it down step by step. Here's what we'll be covering today. So firstly, we'll be taking you through a case study, then understanding the different cover types, premium types and funding options, so how premiums work and different ways to pay for your policy, the policy selection process, what to look for when choosing cover, and we'll also answer some frequently asked questions about life insurance. Before we get into the details, Russell, let's cover off our case study.
So our case study for today, we've got a 40-year-old male, non-smoker, with no pre-existing medical conditions, living in New South Wales, looking for some fairly comprehensive coverage. We've got a couple of scenarios that the client is looking at. So firstly, we're looking at $1 million worth of life insurance with $750,000 any occupation TPD cover, along with $100,000 worth of trauma cover. And he's also considering income protection, looking at protecting up to 70% of his salary, with either a 30-day waiting period with a benefit period to age 65, or a 90-day waiting period, also with a benefit period of age 65.
Thanks, Russell. Before we continue, I just want to note that the information that we'll be discussing today is general in nature. You should obtain advice before you act on this information or make any decision about your personal circumstances or insurance needs. Now, let's start with the basics, understanding the different types of life insurance cover and what they actually do. Life insurance isn't just one product, it's an umbrella term for a few different types of cover. Russell, can you walk us through the key cover types and what they protect us against?
Yes, Megan. So firstly, we've got life insurance, which is, that umbrella term, but more specifically, the cover type is going to cover us for death or terminal illness, typically speaking. So if you were to pass away or diagnosed with a terminal illness, that's going to go ahead and pay you out or your family out that lump sum of money, which you can then use to, fund the children's education, funding the family's financial future as they move forward without that loved one. The other type is total and permanent disablement cover, and that there is to really protect you against you becoming permanently disabled. Now, there's two main definitions that exist in the industry. The first one is an own occupation definition, or the second one is an any occupation definition, which means that you're disabled to such an extent that you're unable to perform any occupation suited to you by education, training, or experience. Now, that definition selected will be outlined in your policy that you have gone ahead and selected. And the any occupation definition is a little bit more affordable than the own occupation. Own occupation is a little bit more expensive because it's based on your specific occupation at the time of claim. The other cover type that we've got is trauma insurance. Trauma insurance is going to pay you out a lump sum if you're diagnosed with a traumatic condition as defined in the product disclosure statement. Typically, you'll find the 80% of all trauma claims are from heart attack, heart disease, stroke, or cancer. But depending on the policy that you look at, for standard trauma policies, you're normally going to be covered for 30 to 40 conditions. And your plus trauma policies, you're going to be looking at covering yourself for an extra 10 to 15 conditions. And that lump sum of money can be used to fund those medical costs. You want to use that money to fund, pay down your mortgage. You may want to have your loved one, by your side, or take time off work while you focus on fighting this condition that you've got, and or looking to get the best medical treatment that you've got to recover from that traumatic condition. The fourth one is income protection, and that's going to protect you by providing a monthly benefit of up to 70% of your salary should you suffer a sickness or accident that keeps you off work for a period of time. Now, that period of time is known as a waiting period. Typically speaking, they are 14 days, 30, 60, 90, or even up to 2 years waiting periods. And they're going to continue to pay you a monthly benefit so long as you continue to meet the policy terms and conditions. But what that's really designed to do is to cover those ongoing monthly costs when you have a sickness or an accident and you can't go to work. So when we look at this case study, what we can see is the couple of scenarios that we're going to be looking at today. And what you'll also see is that there is a little bit of overlap here between our trauma insurance and our income protection, as well as our total and permanent disablement cover, as well as our income protection. So why do I say that? So potentially, if you were diagnosed with a traumatic condition, right? So let's say you had cancer, there is a high likelihood that you could also be claiming on your income protection if that cancer or that traumatic condition kept you off work for longer than 30 days. So you'll see in this case study, we also have a option where the income protection has a 90-day waiting period, and you'll see the impact on the premium. You'll also find with total and permanent disablement cover that here too again can also be covered through an income protection policy. So while they are both different, potentially you could claim on both of these benefits if you were made totally and permanently disabled. So here again, we may look to reduce that total and permanent disablement cover if we've got a policy that provides a long-term income protection benefit up to age 65. So when we look at this scenario, we've got a sum insured of $750,000 with this particular scenario, and a benefit period to age 65 on the income protection. So if we have a look at the first scenario, what we can see now is we've got $1 million worth of life insurance, $750,000 of any occupation total and permanent disablement cover, with $100,000 worth of trauma insurance. Now, these policies have been set up as a combined policy or a linked policy. So what that means is that if you were to claim the $100,000 on this trauma policy, what would happen is your TPD would reduce down to $650,000, and your life insurance would reduce down to $900,000. So we're going to cover this off a little bit more as we go along, but I just want to go through and explain to you how this particular pricing structure has been set up. What you can see here is we've got this customer who's on a $100,000 salary, looking at a 30-day waiting period with a benefit period to age 65, 40 years old, male, non-smoking accountant, living in New South Wales. The quotes that we're going to be focusing on today are going to be monthly. There is a discount, if about 6 to 9%, if you are looking to pay for those annually. So if that does fit into your budget and your cash flow, definitely worth considering. We're going to be covering off the different premium types. So this particular premium type is variable age stepped, and this particular quote is paying through a credit card or direct debit. Okay, so there's no additional fees for using a credit card, but this is the scenario we're going to be looking at today. Fantastic. So let's now have a look firstly at what this looks like. So to start off with, what we've got is a number of different providers here. And as you can see, there's a number of different options that we have available on our comparison engine. And these are just listed in ascending order. So the cheapest at the top, going down to I suppose, the more expensive options further down. So when we have a quick look here, and this is not an endorsement for any one of these particular brands on this comparison engine. The reason I've presented this view is more around pricing and what that looks like. And we will talk through some of these options throughout this case study, but just wanted to highlight it's just purely in ascending order. So as we can see, if we look at the most competitive, we're sitting at about $140.37, $141 and about $145, right? So we're going to get into a bit more detail later, but I just wanted to show you, if we look at the other case study, what we can see here is that we've actually got a 90-day waiting period. Okay, so that 90-day waiting period, that means that that sickness or accident on your income protection policy is going to have to keep you off work for longer than 90 days before you start to be entitled to the monthly benefit. Okay, so you can see here, just looking at the three most competitive options, you can see the impact on the premium. We're sitting at $110, $112, and $115. Okay, so just want you to be mindful of that impact on the premium. So you can see there's a fairly significant savings if we were to look at that 90-day waiting period. However, the drawback to the structure is that you would need to find the money and the funds to look after yourself if you were on a sickness or an accident. For that first 90 days, you would really need to be able to fund that yourself. So through an emergency funding option or credit cards, you know, you'd really just have to work that out and just make sure that that worked for you. So we've got those both two scenarios. So when we have a look at, once you've established those levels of cover and the types of cover, the next things that we really want to start to think through is we want to start to think through how and which way should I be looking to structure my policy, and which particular premium should I be looking at. Okay, so what I'll do is I'll just go through and explain the premium options, and then we'll loop back to our case study again. Okay, so there's basically two types of premium that are available in the market. The first one is a variable premium. Now, typically speaking, this is based on your entry age into the policy. Typically speaking, there's no premium increases due to age, and there is a higher initial cost due to this option. When you look at your variable age stepped premium, that's based on your current age. Okay, premium increases as you age and as you get older, and typically speaking, they start at a lower initial cost. Okay, now just be mindful, it doesn't matter which option you choose, premiums can increase due to a change in the cover level. So if your level has gone from $1 million up by CPI to $1,050,000, for example, your premium will go up because you're now covered for a higher sum insured. If the base rates change, so if the insurer looks to increase rates because of the claims experience that they're having across the portfolio, they may then go ahead and increase rates because they're higher than anticipated through the actuarial modeling. There could also be an increase in policy fees, and there could be also an increase in stamp duty. So depending on which premium you're going to select, you need to be mindful that they can change and they're not set in stone. But the key differences here is that that initial part of your policy is going to be focused and based on your entry age when it comes to variable premiums. And with age stepped premiums, it's based on your current age. So every anniversary, it's going to be based on your current age on a stepped variable age stepped premium. So let's go and have a quick look and see what this actually looks like in our case study. And moving forward, what I'll do is I'll just go ahead and use the one option for now. I'll go ahead and just look at the 90-day waiting period to age 65. Now, I'm going to go ahead and just have a quick look at this particular policy here. No particular reason why at this stage, but I just wanted us to have a quick look, and let's look at the impact of these different premium types. Okay, so what we've got here is we've got a graph illustrating the different premium types. So you can see across the top here, we've got variable age stepped premiums, and you can see over here, we've got the variable premium. So in this particular NEOS option, if we were to select this particular policy, a variable premium would be starting off at $439.76 per month. Whereas you've got a variable age stepped premium, which is sitting at $131.11 per month. So let's have a quick look at what this looks like, because when you're deciding on what premium you want to select, you really need to be thinking about two things, really. The first thing is you need to be thinking about how long am I thinking of retaining this policy? I suppose is question number one. Question number two is you need to be thinking about your cash flow. So it's quite a big difference in the premium, so roughly $300 a month. Could you be using that money better somewhere else? Or would you be better off looking at a long-term position around a variable premium type? So each person's scenario is going to be different, but some of the things to think about is to think about what this looks like in relation to a future projection. Okay, so this is a 20-year cumulative total. So here, if you were on a variable age stepped premium, you'd be looking at a total of 154,000 versus 189,000. Okay, so you're going to have to retain this policy for a very, very long time. It hasn't even got to that break-even point at this point with this scenario, right? If we had a look at the 10-year projections, we can see here again the variable age stepped, sitting at $26,938 compared to the $63,291. So you can see in this particular scenario, the break-even point is quite a long way away, and we haven't actually got to that point yet. Would we ever? We'd have to kind of illustrate this to age 65. So most policies will then convert from a variable premium to a age stepped premium or variable age step premium at age 65 or 70, depending on the provider. So in this particular scenario, you actually might never get to that break-even point. So you may then want to consider sticking with the variable age steps premium. Also, just to bear in mind in these particular estimates here, what you'll also see happening is that the level of cover is actually increasing in line with CPI. So as you'll see, the sum insured is going up. So you've got two factors that here at play on the stepped premium. You've got the sum insured going up, but you can also see the increase in the premium based on the age. So you can see a fairly consistent increases as you get older and as that risk becomes higher to the insurer because of the mortality tables and morbidity tables, that there's a higher probability of something happening. You can see the variable premium staying more consistent because a large portion of their policy is going to be based on your entry age, what you started off with. However, you can see the level of cover is going up, and those incremental increases would be based at your entry age when you enter that increase. Okay, so you can see the impact that that has when we look at comparing these two in this particular case study. Now, be mindful, if I was 25 and doing the same scenario, this crossover point would be totally different. So here again, you really need to consider this based on your own circumstance, your own budget, and which option is going to work best for you. So just be mindful of doing that investigation when you're taking that next step on working out how we want to go ahead and set up this policy. Okay. The next thing we're going to be thinking about is we're going to be thinking about how do we want to fund this policy. Okay. Why this is important is what we want to do is we want to look at what's going to work for your particular scenario. Are we going to pay for this directly ourselves, or are we going to pay this through super? Now, there's a couple of different considerations that we need to think about when we're working out how we're going to pay for this particular policy through super or outside of super. Okay, so one of the advantages of having your insurance inside super is that there's no out-of-pocket expenses, right? It can help with your cash flow management, right? That's, I suppose, on the pro side of things. On the cons and the downside of funding it through your super, it's going to reduce your retirement savings balance. So as you know, your super's there to help you retire and fund that retirement. Now, if you keep using your insurance to use your super to fund your insurance, you really need to think about the impact that that's going to have on your retirement savings and in retirement, and think of ways to mitigate that. So you may want to make extra contributions, or you might want to think through how you can mitigate that in the long term. The other disadvantage is that when a policy is structured and owned within a superannuation environment, you'll need to meet both the policy terms and conditions as well as a condition of release before you can get the benefits paid to yourself, and then use that to fund your particular ongoing living costs. Okay, so you'll need to meet both the policy terms and conditions as well as a condition of release. The other thing to also bear in mind is that you're going to be losing some other built-in benefits. So you might have things like funeral advancement benefit, you might have partial TPD, you might have some of those accommodation benefits or something like that in your income protection. Those benefits, typically speaking, are not going to be available if you're funding it through super. The other thing to also bear in mind in this particular scenario, we've got trauma insurance in place, or we're considering trauma insurance, and be mindful that you cannot fund your trauma insurance premiums through your superannuation. It's not permitted, so just be mindful you can't do that. There's a couple of other pros and cons around this setup as well, which I won't cover off here in too much detail. It's kind of a bit more like a superannuation masterclass, but those are really the first things that you want to be considering, and you want to be thinking about the tax deductibility as well. So income protection, they are tax deductible. Those premiums are tax deductible in your personal name. However, be mindful that the premiums would be deductible if you're funding it through your super fund, they would be deductible to your super fund, and at that rate of 15%. Okay, so one of the things that we'll be going through here is we'll just be, with our case study, I'm going to keep focusing on this particular scenario where we're going to be funding it through our credit card and just sticking with that credit card and direct debit. However, you do have the option of a combination of both, or just from your super fund. Now, as I mentioned, what would happen if you put a combination of both? It's going to go ahead and give us a little bit of a breakdown on what that's going to look like, right? So if I just clicked on one of these options, I'm just going to use NEOS here again for an example. You can see here what the option looks like. So if you see here, we've got this would be potentially funded through your super, and this would be funded through non-super. So this would be needed to be paid directly, or here this would be coming through your super. And so if I wanted to go through a combination, I could do something like this. So just be mindful of it. We'll cover it off in a little bit more detail in the next session, where we go a little bit into a masterclass around superannuation and the pros and cons of funding it inside super. However, that's just a really nice high level to get people started. We're always happy to cover off in further details and further questions. Fantastic. So moving forward now, we've decided, that's just a really nice high level to get people started. We're always happy to cover off in further details and further questions. Fantastic. So moving forward now, we've decided, we've gone through that thought, and we've gone and we said, look, we're going to just stick to personally funded policy at this point. And then what we're going to do is let's go and have a look and see how some of the thoughts that we should think through as we go through and consider these different policies and these different options. Okay, so what I've done here is I've gone ahead and I've selected a couple of these policies for us to compare. And I'm going to just talk through 3 policies. I've just gone ahead and selected 3 policies. I will explain to you how I've got to those. But here again, this is more just an example. So just be mindful that this is just for the case study, and you may choose different options yourself. But we'll just go through and talk through some of the built-in benefits in the policies that you may want to consider. Okay, so the first thing that I want to be thinking through when I'm looking at my particular policies and my different options is we want to be thinking about affordability, right? What is going to fit into my budget? So we've established that we wanted age step variable premiums for this particular case study. And we've established that we wanted to go with personally owned and personally funded once we thought through the pros and cons of insurance, funding it through super or funding it yourself. Okay, so what we want to then have a look at is we want to then think through, do I qualify for any of those healthy life discounts, right? Are there any particular promotions that might be available, or might there be any particular discounts that I might look through? Okay, so what you can find here in this particular option here, you can see this MetLife option here includes a healthy life discount. Okay, and you can also see here with NEOS, we've got the preferred discount. So that means if you do have if you meet their eligibility criteria, you meet their BMI requirements, their no smoker status, and their particular requirements to qualify for that, they're actually going to give you that lower premium, which I've got displayed here at the minute. So that's going to save you some money, and definitely things to think about when considering which policy do we want to move ahead with. The next thing I want to really think through is I want to think about, okay, so what are some of these built-in benefits that I'm going to be getting, right, when I go ahead and look at life insurance? So firstly, I want to know, okay, great, so my illnesses are covered, my accidents are covered, right? That's great. That's the core things. My terminal illness benefit, fantastic. That's being covered across all three of these. Now you can see here there's a little bit of a difference with that funeral advancement. So here, MLC is going to pay up to $20,000, right? Which is an advancement of that $1 million in this case study. If you die or or diagnosed with a terminal illness, it's going to pay you this funeral advancement. Sorry, not the terminal illness. You're potentially going to get the full benefit under terminal illness, but it's going to pay you that funeral advancement once you've submitted a fully completed claim form. And that's normally going to happen quite quickly. And then that'll be paid to help assist with those immediate costs. And then the balance will get paid once, they've gone through that full claims assessment and you meet the eligibility criteria. Whereas here at MetLife, you can see that's up to $30,000, and NEOS is the lesser of $25,000 in the sum insured. So, nice to have. You can see the slight differences there. Child cover, so free child cover. So as you can see here, MLC, that's a paid option. MetLife don't offer it, and NEOS have got free child cover up to $10,000 for your children aged between the age of 2 and 17. Here again, nice to have. We've got some of our exclusions, suicide or attempted suicide in the first 13 months. Here again, and here again, very similar. Expiry age 100, 130, and 99. So we can see how some of these now start to compare. The next thing that we're going to have a look at is what am I being covered with? So this is the any occupation definition, total and permanent disablement cover. And what you can see here is that they all have a partial benefit payable on the loss of one limb or one eye. So here again, we can see it's 25% of the sum insured up to $500,000. Benefit is not payable if it's less than $10,000. Okay, here again, that's very similar. And here again, that is very similar. Okay, now when we looked at this option, we did see that this was structured as a combined policy or a linked policy. And what you can see here is that this particular policy has a feature called life insurance buyback included. So what that means is if we had a full TPD payout, our sum insured would reduce on our life insurance from $1 million to $250,000. Okay, So what this particular feature does, and it's built in under this particular policy, is after 12 months, they will send you a letter and say, would you like to reinstate that life cover? Would you like to buy it back and bring it back up to the $1 million? So your total and permanent disablement, you got a full payout in this particular scenario of 750,000. You've now gone ahead, reduced your life cover down to 250,000. 12 months later, you get that letter. It gives you the option to bring it back up to that $1 million worth of cover. So here, that feature is a paid option, and I haven't included it here, but just to let you know, it would be a paid option. Okay. We also have got our standard exclusions, and here again, we're just surfacing some of those exclusions. The PDS is going to have that full definition in there, so really important for us to read that. And then we can also see our expiry ages when that policy or that coverage expires, but also pay attention to your guaranteed renewable age. So what does that mean? That means that that definition of any occupation is going to change when you get to a particular age, and it typically then changes to an activities of daily living definition. So just be mindful of that. Okay. Now, when we're looking at our trauma insurance, be very mindful when we are looking at these different options. What we want to be looking at is understanding whether we're looking at a standard policy or a plus policy. So when we introduced that concept at the beginning of the call, we wanted to really understand how many conditions are we being covered for, and you can normally get a good gauge on that based on whether it's a plus or a standard policy. Okay, so here you can see with this particular option with MLC, you're being covered for 61 conditions. Okay, we can't predict what condition we're going to potentially have as a traumatic condition if we are going to have one. However, definitely look at ones that have got more conditions being covered than not. And you may also, if you have a family and history and anything, then you may want to look at those definitions closer. So let's say prostate cancer or melanoma, then you may want to look even closer at those particular definitions and compare those. But normally what you want to be looking at as a starting point, just understanding the count and seeing how many conditions you're covered for. And then from this, we also want to, okay, out of those 61 conditions, how many of them are partial payouts, or how many of them are going to be the full payout? So you can see here, out of the 61, 20 of those are partial conditions, and you'll get a partial payout, whereas here it's 41 conditions being covered, with 14 of them being partial, 52 conditions covered, with 12 of them being partial. Okay, you can link through here into the PDS to find out more about how those work, and the details are there. So under the trauma insurance, you can see the life insurance buyback. So that's actually paid here with MLC. It's paid here with MetLife, and you'll see here with NEOS, it's paid as well. Trauma reinstatement, that's paid, and we can see here with NEOS, that is a built-in feature. So with our built-in features, what we want to be mindful of is with this particular option, what that means is, let's say, for example, I had a full payout for, let's say, prostate cancer, and I had a full 100,000 paid out on my trauma insurance. 12 months later, they're going to send you through a letter or and ask you, or an email, and it asks you, would you like to reinstate that trauma cover back to the 100,000? Just be mindful, any reinstated trauma is then going to exclude that entire category of trauma cover, right? So that you had your previous claim for. So let's say I had prostate cancer, any reinstated cover would exclude all cancers, right? So I wouldn't be able to make any further claims on the policy under any type of cancer. Okay, so just be mindful of that. And we've also got this listed whether it's a plus or a standard policy. So this has got less conditions. That's flagged as standard, and that's a plus. Okay, we've also got our qualifying periods or our waiting periods for trauma insurance. So typically speaking, most conditions have a 90-day waiting period or qualifying period. So just be mindful of that. So some particular insurers can also see some of the benefits have a longer qualifying period, which is 12 months with some of these here with MLC. So just be mindful of that as well. Okay, got our exclusions, and we've got our guaranteed renewable age there again, and when they're expiring. Okay, so moving on to the income protection, here again, we can see this as sicknesses and accidents being covered across our income protection. And what we want to be having a look at when we come to selecting an income protection policy is we want to be thinking through what is our own occupation disablement definition. Okay, so this is important because this is defined as your occupation at the time of claim. Okay, after a period of time, a lot of policies then change to an any occupation definition, right? So be very mindful of this, really important consideration when selecting an income protection policy. So what you'll typically find at the moment, policies that have a to age 65 benefit period, normally you'll find that they'll offer a period of, say, 2 years on an own occupation definition, and then it will revert to an any occupation definition. Okay, so be mindful of that. However, you had a 2-year benefit or a 5-year benefit period, some providers are actually doing own occupation definitions for the full 5 years. So definitely something to think about, really important. So here again, you can see it's for the first 24 months before it changes to the any occupation definition. You can see for a 2 and a 5-year benefit period, it'd also be own occupation. However, to age 65, it's like that for 24 months only. Okay, very similar over here and over here for the first 24 months as well. Okay, so slight differences, but very, very similar. Looking at the monthly benefit, this is also really important, you know, up to 70%, really important for you to think through that. Some of the policies that we see in the market do step down. So they go up to 70% for the first 2 years and then drop to, say, 60%. There's also one policy on the market that actually drops to 46%. So you definitely want to be thinking about, well, if I'm only getting 70% on my salary being paid to me, or my month, you know, my salary, I want that to be as high as possible for as long as possible, unless you've got some budgetary constraints, then you may want to think of some other options. Okay, just be mindful as well how you're going to go ahead and prove your income. This is really important. So when you've had a claim, or when you're about to go ahead and submit a claim, you need to prove your income for the last 12 months. So really important for you to understand that you'll need to send through, you know, potentially a group certificate or tax return to support your sum insured. Really important. So you will need to do that at claim time, and some of the insurers have got some slightly different pre-claims earnings calculations. So definitely something to also consider depending on your circumstances. The team can help answer any questions that you have here. But typically speaking, it's going to be the average for the 12 months period immediately prior to total disablement. So they're going to, so let's say I get disabled today, they'll say, okay, hey, Russell, could you please send me through your income for the last 12 months? And then they would look, in this particular scenario, I would need to prove and show them that my personal exertion income after business expenses is at 100,000. And then they would potentially then look to pay that monthly benefit, which would be up to 70% of my salary or my sum insured, if that's a lesser number, right? So it's going to be the lesser of my sum insured or up into 70% of my pre-disablement income. Okay, so some of your typical exclusions that you've got is you've got your intentional self-inflicted injuries, attempted suicide, an act of war, incarceration, participation in a criminal act, uncomplicated pregnancy, or childbirth. Okay, so you can see here the exclusions are slightly different with each one of them. So just to be mindful of that. Here again, it's really important you have a look at the PDS, the product disclosure statement, which can be located up here at on any particular one of the brands. And also there's links and hyperlinks to these through here as well. Okay, another thing to keep in mind is your cooling off period. Nice to know that, you know, hey, if I made the wrong decision, you can cancel within the cooling off period and get a full refund. So something to definitely keep in mind. Worldwide cover and also offers interim cover. So that interim cover is really handy. If you're applying for a policy, sometimes it can take a little bit of time depending on how complicated your medical history is, but that can be quite handy to offer you some level of cover. It's normally accidents only and it's really cut down, but it's better than nothing. If you were replacing an existing policy, you wouldn't rely on that. You would want to get your new policy in place before you cancel the old one. But definitely something that is quite handy to have. And then lastly, as we discussed, we've got that Healthy Lives program over here, and then we've got the Preferred Healthy Lives program over here. So just be mindful of that. Definitely worth having a chat to the relevant team member on that. Those can work really well in your favor. So definitely think through that. And if any of those brands are offering any of those initial sign-up discounts and or those Healthy Lives discounts. The Healthy Lives ones normally last for a little bit longer on your policy, whereas those initial discounts will normally step off depending on the particular brand over a year, 2 years, 3 years, or even longer than that. So just be mindful of that as well. Okay, so really important when you're going through and comparing these policies, really want to be thinking through, okay, great, what are the benefits, these built-in benefits, what do I value? What do I want to achieve? This is a great way for you to really look at those snapshots to make an informed decision and then go, okay, I'm really concerned about, how many conditions I'm covered for trauma insurance, or I'm really concerned about this built-in feature. Can I get that turned on? What does that policy actually look like? There, really focus on plus traumas, or I might be really focused on up to 70% for my monthly benefit. So it's really important for you to understand what these are and then look to see which one of those fit into your budget. Okay, so if I now work through the next step is, so once you've gone ahead and you've had a review of the particular features, you're happy with that particular policy, important you read the product disclosure statement as we mentioned, and then it's really important when you do go ahead and apply for a policy, really important that you comply with your duty to take reasonable care. So often we get asked the question, who has the best claims payout rate? Who has XYZ stats around claims, right? So it's really important, first and foremost, understand what you're being covered for, which we've got through our product disclosure statement. You've got what you're covered for and what you're not covered for. It's really clear in a product disclosure statement, but important you read it or ask the relevant team member or person you're consulting for your particular policy, so it's really clear. And the next thing is you want to really comply with your responsibility to comply with your duty to take reasonable care when you complete the application. So what does that mean? It's about answering all the questions truthfully and honestly to the best of your knowledge when you complete that application form, right? Really, really important. It is a requirement. It's in the Insurance Contracts Act. Really important, because if you do not do that, what they can do is they can cancel your contract if they do find out you didn't comply with your duty to take reasonable care. So really important to put as much information in as possible. If you're not sure, ask the question at application time. It's always better to over disclose than under disclose, because at claim time, the insurer will check your Medicare history. They will check your PBS history. They may check with your employer. They might check with previous insurers. They may check with your doctor as well. So it's really important when you do decide to take out a policy to really focus on answering those questions as accurately and as detailed as possible, because this really is an important part. You'd rather find out today whether they're going to insure you as opposed to a claim time. Fantastic. I'll hand that back over to you, Megan. Was there any questions on that presentation, or any other questions that you wanted to flag with me?
Russell. That was really insightful. Before we wrap up, let's answer some common questions we get. First up is, what should I look for in a life insurance policy?
Yeah, great question, Megan. I think when you're looking at a life insurance policy, so just life insurance, right?
Yes, just life insurance.
Okay, so if you're looking at life insurance, I think some of the things that you really want to be thinking about is you want to be thinking about some of those particular options. Specifically, when we look here, we want to be really thinking about, am I covered for all sicknesses and all accidents, first and foremost, and am I covered for terminal illness? That's really your core part of the policy. The nice to haves is the funeral advancements and the free child cover. So depending on your circumstance, you may want to, the free child cover, if you've got 2, 3 children or any children, that you may really value that free child cover, or you may want to add it on. That can be quite valuable. And there's also another particular benefit, not in this particular scenario. There's accidental injury benefit as well. So if you're not looking at a full total and permanent disablement policy, you may want to think about an accidental injury benefit that's built into select providers. So it really depends on your circumstance and what you're looking to achieve. But I always look at it as free fries built into your Mac meal. So the more fries we have, typically speaking, clients like that. It's going to offer us more value. So really important for us to consider that when we are looking at selecting a particular life insurer.
Awesome, thank you. And next up is, how do I find a total and permanent disability policy that's right for me?
Yeah, a great question. I think it's very similar to when we're looking at the life insurance side of things. So the first thing when we're looking at total and permanent disablement cover, what I'd be thinking about is, what's the definition that you want? Really start there, right? Do I want to own occupation definition, or do I want an any occupation? So we can see that this is an any occupation definition in this particular scenario, but think about that first. Own occupation might be considered if you're a professional, you're a surgeon, you're an accountant, you're a lawyer, something like that. Other, higher risk occupations might not be able to get any occupation definition. So, carpenters, plumbers typically can't get any own occupation definition. They can only get any. So firstly, establish which definition you want. Then what you want to do is then think through here again, are there any of those built-in benefits, or are there any paid options that I want to turn on? So you'll find the partial benefit is quite a common benefit when it's outside of super. If it's inside of super, most don't offer it. But then think about, should I look at life insurance buyback? Should I turn it on? This is a nice benefit if you have made a full and had a successful full total and permanent disablement claim on a linked life and TPD policy. This particular benefit reinstates or buys back your life insurance 12 months after a full claim. You get a 30-day window to do that, where they send you out a letter. So that's also something to definitely consider if you are structuring your policy that way. And yeah, I think those are some of the key things that I would be focused on if I was choosing a particular total and permanent disablement policy.
That's great, thank you. And next on my list here is, how do I find the right income protection policy?
For income protection, I would be definitely thinking through, firstly, am I covered for sicknesses and accidents? That would be one of the key things. The next thing I'd be really thinking about is that waiting period. What's the waiting period and what's the benefit period, right? So it's really important that we're super clear on those options first. So in this particular scenario, we're at a 90-day waiting period with a to age 65 benefit period. So I'd really be thinking through that first. And then the next thing I'd be thinking about is that length of own occupation disablement definition. So, if we're looking at to age 65, it can be a maximum of 24 months, as we can see here across these particular providers, but typically speaking, that's what we find with our retail insurance brands. But if you're looking at a 2-year or a 5-year benefit period, look to see if we can get that as long as possible. Because after that 24 months, in this particular scenario, what happens is they now then look to assess you on any occupation definition after that period of time. So that means the claim eligibility criteria just got harder, right? So previously, or when they've initially assessed you, it's based on your own occupation at the time of claim. However, after 2 years, it would revert to any occupation suited to you by education, training, or experience, right? So a doctor's then got to say, okay, hey, Russell, you have, done, X and Y in your career. You've trained for this. You've, got a university degree, etc. You've got to be unable to do any of those before any of those, as well as all your duties before you could potentially continue that claim. So that would be the next thing I'd look at. And the other one was then be looking at that monthly benefit. Is that up to 70%, or does it tear down? Really important for you to have a look at that. And then also that proof of income period, really important. If you're self-employed, you may want more flexibility. If you're an employee, you might be okay with less flexibility because your income's fairly consistent. So it's really important for us to be mindful of that. That has tightened up a lot recently, but just be mindful of that. That's also worth a consideration.
Great, thanks. And then the last one I think we'll cover off today is there a way for to pay for some of my policy through super and some personally?
Yeah, great question. So typically speaking, you can set that up, and that's quite a common setup that people do look at these days. So what you can do is you use a structure called super linking. So what you typically would do is you might put in, say, life insurance and any occupation TPD cover, for example, and funded by your super fund and held in your super fund, and then you might super link your trauma insurance. So what that means is you would then be paying that portion of your premium. So just that portion of trauma insurance would be funded personally and paid for you personally. So that's how super linking works.
That's great. Thanks, Russell. Yeah, that brings us to the end of today's video. We've covered off a lot, from understanding different cover types and premium structures to choosing the right policy. If you're considering life insurance and want to explore your options, Life Insurance Direct can help you. You can visit lifeinsurancedirect.com.au for more information or to get a personalized quote. Russell, thanks again for sharing your expertise today.
Thanks, Megan, for the invitation, and appreciate you taking the time to present this with me.
Thanks, everyone. If you found this helpful, be sure to like and subscribe for more. Until next time.